If you think the S&P 500 returns 10% every year, I have good news and bad news. What's up, everyone? My name is Cade. On this channel, I share my learnings and experiences to help you become a better investor and get better with your money. So today, we are going to be looking at the history of the S&P 500, average returns, what you can expect, how often it drops, how big the drops are, and what the data shows might be coming in the next decade. To start off, you need to know that the average is not normal. 10% is usually the return that is advertised for the S&P 500, 7% after inflation. But if you look back at the historical returns at S&P, you'll realize that almost in no single year does it return exactly that 10% number or that 7% number adjusted for inflation. Most years are either way higher or way lower than that. So the 8 to 12% that floats around out there is really what you can expect as a long-term average. And this is not a promise for what you will see as a specific return year over year over year. So how often is the market actually up? If you look back at the calendar years, you can expect the market to be in the green usually 70 to 75% of the time. But if you look back at the individual year returns, this usually ranges from plus 30% to minus 20%. If you expand this out a little bit on a decade to decade basis, you see a similar trend. There's some decades that have absolutely crushed it, and there are other decades that have fell short and turned into what is called a lost decade, or almost no growth is seen over those 10 years. Luckily, in the last 10 years now, we have seen great growth from the S&P 500, driven mostly by AI and tech. So hopefully that continues, but we could likely expect a decline somewhat in S&P 500 returns over the next few years because the last handful of years have just been stellar. Volatility and drawdowns, though, are just a part of investing in the S&P 500. And here's the gut check. Even in years that the S&P 500 finishes in the positive, there's an average intra-year decline of negative 14%. So basically, you have to expect some volatility with the market when you are investing. Don't go panic selling just because there's a small drop. And remember, if you sell on the dip, you are sacrificing those gains and just basically handing them on a silver platter to somebody else. So don't be scared of a little bump here and there. Over the long term, the market average is usually very consistent, but there is some volatility mixed in there between that most people skip over. Dividends and inflation also play a big part in this, and so you want to look at the S&P 500's total returns with dividends reinvested, as it is accounted for a large majority of the returns. When it comes to inflation, there's the 10% nominal number and the 7% inflation adjusted number. You really want to use the 7% inflation adjusted number when doing any type of financial calculation, because that is the real return of the S&P 500. If you need a 7% return to meet your goals, it's probably best to dial it back, maybe use a 5 or 6% just to be conservative. So what about the next 10 years? Most of these predictions are based on valuations, and if you have been paying attention to the market lately, you know that valuations are extremely high. This doesn't mean go sell everything. What it likely means is that we might just need to temper our expectations just a bit over the next few years. So keep that in mind when you are investing. We likely won't see the back-to-back-to-back 20% year returns that we have seen. But, there might be some red years in there, but the long-term average is still going to remain consistent. So knowing this, temper your expectations a little bit, but don't stop investing because of it. And just some kind of real words of advice here at the end. On a 1 to year 3 basis, you really have to expect everything from negative 30% returns to plus 40%. On a short-term basis, you really don't know what is going to happen. Once you lengthen that time frame and get into the 10-year or so mark, you can kind of expand this a little bit and move that into probably the 4 to 10% range. I would say maybe 4 to 7% range annualized returns are what you can expect to be on the safe side. And over 20 years, the market has never returned a negative return. So, you can have pretty positive expectations for extremely long-term investing, but remember that the road there is going to be bumpy. It's not a straight line up, so make sure that you stay consistent, as that is the most important part of being a successful investor. If this helps you reset your expectations a little bit, go ahead and grab the S&P 500 Returns Exposed PDF down below. It's free. Send it to your friends, send it to your family, send it to your enemies. Let them know what they're saying isn't true. But no, I'm just kidding. In all reality, thank you guys for watching. I hope you found this video helpful. If you want to see more content like this, hit the subscribe button, and I will see you in the next video. Thanks for watching.